That's how much physical gold has reportedly drained from London vaults over the past several months, according to Bank of England data and LBMA reports. Not paper gold, not futures contracts. Physical metal, loaded onto planes and shipped out of the United Kingdom. To put that in perspective, that's approximately $190 billion worth of gold at current prices. More than the GDP of over 150 countries. Enough gold to fill nearly 100 armored trucks. And if you think massive gold movements between global financial centers don't affect you personally, I need you to understand exactly what this signals. Because gold doesn't move in quantities like this by accident. It doesn't relocate across continents on a whim. When 2,400 tons of the world's oldest money leaves the historic center of global gold trading, something fundamental is shifting. And most people have no idea it's happening. While you were following stock market headlines and cryptocurrency prices, the oldest wealth preservation asset in human history was being physically relocated at a pace not seen in decades. From London, the city that has served as the center of global gold trading for over 300 years, the location of the London Bullion Market Association, the institution that sets the global gold price twice daily, the home of the Bank of England's gold vaults, holding reserves for over 30 nations. Gold is leaving. Not gradually, not in normal trading volumes, in quantities that have created delivery delays stretching to weeks, in volumes that have depleted visible inventory to concerning levels, in movements that veteran gold traders describe as unprecedented in their careers. According to multiple reports, wait times for gold withdrawal from Bank of England vaults stretched to 4 to 8 weeks in early 2025. Normal wait times are days, not weeks. When delivery delays extend that dramatically, it signals that demand for physical metal is overwhelming available supply. It signals that someone, or multiple someones, want their gold badly enough to accept significant delays. The question isn't whether this is happening. The LBMA data confirms it. The question is why, and where this gold is going. Now, let me be clear about sources before we continue. I'm drawing from Bank of England vault reports, LBMA clearing statistics, COMEX warehouse data, World Gold Council research, and reporting from Reuters, Bloomberg, and the Financial Times. These aren't fringe sources. These are the official institutions that track global gold movements. The 2,400-ton figure comes from aggregating reported outflows across multiple sources. Some estimates are higher. The exact number is difficult to verify, because not all gold movements are publicly reported. What I'm presenting is the documented pattern of gold migration, the historical precedents for similar movements, and the potential implications of what this shift signals about global financial confidence. When you see the complete picture, the implications become difficult to dismiss. By the end of this video, you'll understand exactly why gold is leaving London, where it's going, and what similar gold migrations have historically signaled. Because here's what most people don't realize. Massive gold movements between financial centers have preceded every major monetary transition in modern history. There's a documented pattern here. A pattern where physical gold flows anticipate what paper markets later confirm, where the movement of real metal signals what institutional players expect about currency systems, political stability, and financial confidence. Same sequence, same institutional behaviors, same repositioning before major shifts. Gold moved before the collapse of Bretton Woods. Gold moved before the 2008 financial crisis. Gold moved before every major currency revaluation of the past century. And gold is moving now at historic pace, in a specific direction. The only question is whether you understand what this movement historically signals, or whether you'll realize its significance only after the implications become obvious to everyone. Stay with me. The next 15 minutes will change how you interpret gold market data forever. To understand what the London gold drain actually signals, you need to understand how physical gold movements work within the global financial system, not the simplified version, the actual infrastructure that's been operating for centuries. Global gold moves through a precise institutional framework with identifiable patterns. Understanding this framework reveals what current movements actually mean. The London hub model. For over 300 years, London has functioned as the primary hub of global gold trading. The LBMA facilitates approximately $50 billion in gold trading daily. The Bank of England vaults hold gold for over 30 central banks and countless commercial institutions. Gold doesn't need to move physically for ownership to transfer. It sits in London vaults while paper claims trade above it. This system works because everyone trusts that the gold is there, that it will be delivered if demanded. The system functions on confidence. When confidence holds, gold stays in London. When confidence wavers, gold moves. The physical paper disconnect. Paper gold markets dwarf physical gold supply. The LBMA trades hundreds of times more gold in paper claims than physical metal available for delivery. This works because most claims are never exercised. Traders settle in cash, not metal. But when enough participants demand physical delivery, the system strains. Delivery delays emerge. Premiums spike. The paper market price disconnects from physical availability. This disconnect is the canary in the coal mine. When paper and physical diverge, it signals that trust in paper claims is weakening. The directional signal. Gold moves for three primary reasons: arbitrage opportunities, political risk, and systemic concern. Arbitrage moves gold to where prices are higher. This is normal market function. It balances prices across regions. Political risk moves gold away from unstable jurisdictions. This is institutional hedging. Countries and institutions relocate reserves when they fear seizure, sanctions, or instability. Systemic concern moves gold toward perceived safer storage and away from over-leveraged financial centers. This signals worry about the paper system itself. The current London drain shows elements of all three. Understanding which dominates reveals what institutions actually expect. Now let me prove that gold movements have historically signaled major transitions. 3 examples: 3 gold migrations, same pattern of relocation before crisis, 1965 to 1971, the pre-Nixon shock gold drain. This example matters because it shows exactly how physical gold movements signaled the coming collapse of the Bretton Woods system years before Nixon's official announcement. Under Bretton Woods, the dollar was convertible to gold at 35 per ounce. Foreign governments could exchange dollar reserves for physical gold from U.S. vaults. The system required confidence that America had sufficient gold to honor these commitments. By 1965, that confidence was fracturing. France, under President de Gaulle, began systematically demanding gold for dollar reserves. Not occasionally. Systematically, ships carried gold from New York to Paris. The French understood that America had printed more dollars than gold could back. Other nations noticed. The gold drain accelerated. Between 1958 and 1968, U.S. gold reserves fell from approximately 20,000 tons to under 10,000 tons. Over half of America's gold left the country in a decade. The movement was visible in official data. Anyone watching vault reports could see the direction. But most people weren't watching. They trusted the official narrative that the dollar was sound. The gold told a different story. The gold was leaving. August 15th, 1971. Nixon closed the gold window. The Bretton Woods system collapsed. The dollar devalued dramatically against gold. Those who had converted paper to physical gold before the closure preserved wealth. Those holding dollar claims saw purchasing power evaporate. The gold movement predicted the crisis by years. The institutional players who understood the signal repositioned accordingly. Pattern established. Gold moves before systems break. 1999 to 2001, the brown bottom and UK gold sales. This example matters because it involves London directly, and because it demonstrates how government gold sales at market bottoms often precede major price moves in the opposite direction. In 1999, British Chancellor Gordon Brown announced that the UK would sell approximately 400 tons of gold, roughly half of Britain's gold reserves. The announcement itself crashed prices. Gold fell to historic lows near $250 per ounce. The sales were conducted through public auctions between 1999 and 2002. The British government received approximately $3.5 billion for gold that would be worth over $30 billion at today's prices. This became known as the brown bottom, the worst-timed government gold sale in modern history. But here's what's less discussed. While Britain was selling, other nations were quietly accumulating. China began building gold reserves during this period. Russia started accumulating. Central banks that would later emerge as the largest gold holders used British selling as a buying opportunity. The physical gold didn't disappear. It relocated from British vaults to Asian vaults, from Western central banks to Eastern central banks. This redistribution was visible in gold flow data. Anyone watching knew that while Britain sold at the bottom, others were buying. Within a decade, gold prices rose from $250 to over $1,900, a 660% increase. Those who accumulated during Britain's selling saw enormous gains. Britain locked in losses that economists still debate as the worst financial decision in UK Treasury history. The gold movement signaled the coming bull market. The direction of flow from west to east signaled the shifting center of gold accumulation. Pattern repeated. Gold flows predict price movements. Direction of flow predicts who benefits. 2012 to 2016. Germany's gold repatriation. This example matters because it demonstrates how even close allies begin recalling gold when systemic concerns emerge, and because it revealed how little physical gold was actually available in supposedly deep vaults. In 2012, Germany's Bundesbank announced plans to repatriate 674 tons of gold held in foreign vaults, primarily in New York and Paris. The request seems straightforward. Germany wanted its own gold in its own vaults. What happened next shocked observers. The New York Fed initially indicated the repatriation would take 7 years. 7 years to ship 300 tons from New York to Frankfurt gold that Germany legally owned, gold that was supposedly sitting in Fed vaults waiting for collection. Why 7 years? The official explanation cited logistical complexity and security concerns. Skeptics suggested a different explanation. The physical gold wasn't readily available. It had been leased, swapped, or otherwise encumbered. Returning it required unwinding positions that took years to settle. Germany eventually accelerated the timeline, completing repatriation by 2017. But the initial delay raised questions that have never been fully answered. Why can't a nation retrieve its own gold promptly? What does a 7-year timeline suggest about the actual availability of gold in major vaults? The German repatriation triggered a wave of similar requests. Austria audited gold holdings. The Netherlands repatriated gold. Other European nations began questioning whether their gold was actually where it was supposed to be. The movement was away from New York and toward home vaults. The direction signaled declining trust in the custodial arrangements that had existed since World War II. Pattern confirmed. Gold repatriation signals declining. Trust in custodians? Delays signal supply tightness beneath the surface. 3 examples. 3 gold movements, each preceded or signaled major shifts in monetary confidence. Now, let me show you what's happening with the London drain right now, and why this movement may be signaling something significant. According to Bank of England data and LBMA reports, gold holdings in London have declined substantially over the past several months. Various estimates suggest outflows of 2,000 to 2,400 tons or more. Let me break down where this gold appears to be going. Destination 1, United States, the COMEX. The largest flow appears to be toward American vaults, particularly those serving the COMEX Futures Exchange in New York. COMEX gold inventory has surged during the same period. London inventory declined. The correlation is visible in warehouse reports updated daily. Why the movement to America? Multiple factors appear relevant. First, tariff concerns speculation about potential U.S. import tariffs on gold created arbitrage incentives. Traders moved gold to America to avoid potential future duties. Whether tariffs materialize or not, the fear drove physical relocation. Second, price premiums. COMEX gold traded at premiums to London prices during this period. Arbitrageurs profit by buying in London and delivering in New York. The premium attracted physical metal. Third, delivery demands. COMEX has experienced elevated delivery requests. When futures holders demand physical metal rather than cash settlement, inventory must grow to meet obligations. The flow to America is documented. The question is whether it represents temporary arbitrage or structural repositioning. Destination 2, Asia, China, India, Singapore. Significant gold continues flowing eastward, continuing a multi-year trend. Chinese gold imports through Hong Kong and direct channels remain elevated. The Shanghai Gold Exchange continues posting strong withdrawal figures. China doesn't export gold, so every ounce imported stays. India's gold demand remains culturally robust. Despite government attempts to reduce imports, Indian consumption continues near historic levels. Singapore has emerged as a growing gold storage hub, attracting wealth-seeking Asian jurisdiction storage. This eastward flow isn't new. It's been occurring for over a decade, but the current pace appears accelerated. Destination 3, central bank vaults. Various nations. Central bank gold buying continues at elevated levels according to World Gold Council data. China has added hundreds of tons to official reserves. In recent years, Russia's gold holdings have grown substantially since 2014. Turkey, India, Poland, and numerous other nations have been consistent buyers. These central banks aren't buying gold to trade it. They're buying for strategic reserves. Once gold enters central bank vaults, it typically doesn't return to market for decades, if ever. This demand represents permanent removal of supply from trading markets. Now here's why the London drain creates strain. London's LBMA system operates on fractional reserves. The paper claims trading daily vastly exceed physical metal available. This works when most claims settle in cash rather than metal. When physical demand spikes, when multiple parties want actual gold, the fractional system strains. Delivery delays emerge. Premiums appear. The gap between paper prices and physical availability widens. Bank of England delivery delays extending to weeks suggests this strain is real and current. And here's the forward-looking concern. If COMEX is accumulating gold to meet potential delivery demands, if central banks continue buying for reserves, where does London source gold to meet future claims if current holders want delivery? The paper gold market works on confidence that metal will be available when demanded. When that confidence wavers, the system that has functioned for decades can destabilize rapidly. We may not be at that point. But the direction of gold flow suggests Institutional players are preparing for scenarios where physical possession matters more than paper claims. Now, I know what some of you are thinking. Let me address the counter-arguments directly, but this is just normal market arbitrage. Gold moves to where prices are higher, nothing unusual. Arbitrage does explain part of the flow, but arbitrage typically bounces quickly. When prices equalize, flow stops. The current drain has persisted for months. The scale exceeds what simple arbitrage would explain, and the direction is consistent, not oscillating as pure arbitrage would suggest. Normal arbitrage is bidirectional. This flow is persistently one-directional. But the Bank of England still holds plenty of gold. London isn't running out. The Bank of England holds gold for other central banks. Not all gold in their vaults is available for commercial use. When measuring commercially available gold in London, the picture is different. And even if gold remains, the delivery delays suggest that available supply is not meeting current demand. Delays are the market signal that matters, not total reported inventory. But COMEX is just experiencing temporary elevated demand. It'll normalize. Perhaps. But consider why demand is elevated. If traders are concerned about counterparty risk in paper markets, if institutions want physical possession rather than vault claims, if the shift reflects declining trust in traditional custodial arrangements, then the normalization might not occur. The temporary elevation might be the beginning of structural change, but gold doesn't matter to the modern financial system. It's a relic. Central banks don't treat it as a relic. They're accumulating at the fastest pace in decades. BRICS nations don't treat it as a relic. They're building gold-referenced payment systems. The wealthiest families on Earth don't treat it as a relic. They maintain gold allocations regardless of market conditions. Actions reveal actual beliefs. Official statements often don't. But if there was a real problem, financial media would cover it. Financial media reported the delivery delays. They reported the COMEX inventory build. They reported the central bank buying. What they haven't done is connect the dots. Explain what the pattern historically signals. Present the implications for ordinary investors. That's precisely why channels like this exist. So what does this mean for you? Practically, specifically. Right now, I'm not a financial advisor. I can't tell you what to do with your money, but I can share what the data suggests and what historically informed observers have considered during similar gold market conditions. First, understand the difference between paper and physical gold. Gold ETFs, futures contracts, unallocated accounts, these give you price exposure. They don't give you metal. In a scenario where paper claims exceed available physical supply, these instruments may not perform as expected. If gold is part of your financial planning, understanding what you actually own matters. Paper claims and physical possession carry different risk profiles, particularly during market stress. Second, recognize what central banks are doing. Central banks are buying physical gold at historic pace, not gold ETFs, not futures. Physical metal in their own vaults. When the institutions that create currency choose to accumulate the one asset they can't print, that's a signal worth noticing. Their actions suggest their actual expectations about currency systems. You don't have to do what central banks do, but you should understand what their actions signal. Third, pay attention to physical market indicators. Premiums between physical gold and paper prices. Delivery delays from major vaults. COMEX registered versus eligible inventory. Central bank buying reports from the World Gold Council. These metrics are publicly available. They provide early warning of stress in physical markets before it appears in price charts. Fourth, understand the potential timeline. Gold market stress can persist for years before resolving in major price movement. The 1960s drain preceded 1971 Nixon shock by years. The brown bottom sales preceded the bull market by years. Markets can remain irrational longer than expected, but the direction of physical gold flow tends to eventually determine price direction. Fifth, consider custody and jurisdiction. If institutions are moving gold to their home jurisdictions, if central banks prefer gold in their own vaults, if the theme is physical possession over paper claims, these behaviors might contain wisdom applicable to individual decisions as well. Not necessarily replication, but consideration. If this analysis provided value, subscribe to The Silent Economy and hit the notification bell. I release new research weekly, and the next video breaks down exactly which forms of gold ownership have historically performed best during market stress, the specific premiums and spreads that signal danger versus opportunity, and the custody considerations that matter most. Drop a comment below. Tell me what you're seeing in gold markets, whether you're concerned about paper versus physical dynamics, what questions you have about this gold movement. I read every comment. This channel grows through engaged discussion with people who understand that the most important market signals often are not the ones making headlines. Here's what I want you to remember. Their actions tell you their expectations, regardless of what anyone says publicly. Gold is leaving London, moving toward physical delivery venues, moving toward national vaults, moving from west toward east. This direction has persisted for over a decade, but appears to be accelerating. The gold itself doesn't lie, it doesn't spin, it doesn't manage narratives. It simply moves to where its owners believe it should be. The pattern is historical. The current movement is documented. The direction is consistent. You don't have to believe the gold drain signals anything dramatic. But you should at least know it's happening. At least understand what similar movements have preceded historically. At least consider what institutional behavior reveals about expectations. The gold doesn't care if you watch it. It doesn't need your attention. It just moves, like it always has, toward where the smart money believes it belongs. The information is here. The vault data is public. The choice is yours. Thanks for watching The Silent Economy. And remember, the people who understand market transitions aren't always the ones watching price tickers. They're the ones watching where physical assets actually flow. 2,400 tons. Now you know where it went.